Welcome to The Long-Term Investor. Today with me, I have Dan Rasmussen, author of The Humble Investor. Dan, thank you so much for joining me here today.
My pleasure. Thanks for having me, Peter.
The Humble Investor, I was curious what it was going to be about. I followed you on Twitter. Well, I still follow you on Twitter. I just don't use it that much. But I have followed you for years. You were one of the key contributors to FinTwit, or Financial Twitter for those who don't know, in what I consider to be the peak Twitter years. And Twitter's changed a lot. And so I was really excited when I got to know that you had a book and read it. And the central premise is really built around humility in investing. So I was hoping maybe we could start with you explaining why humility is crucial and how often investors are going to mistake confidence for competence.
Yes, I think it's one of the central challenges of investing is how unpredictable the world is. We see through a glass darkly. There's a famous study on predicting earnings growth, revenue growth, and earnings growth. And one of the interesting findings from it is that historical earnings and revenue growth has no predictive power on future revenue and earnings growth. So if you say, hey, if I looked at the top 10% of fastest growing firms, what's their future 1, 3, 5 year growth rate? Well, it's no different from flipping a coin what it's going to be. So there's this break between the past and the future. But our brains are wired, the same mechanisms in the brain we use to forecast are the ones that we use for memory. And I think if you think back to like the Stone Age, right? If you go and find a spring or a place where there are lots of rabbits, and then you want to forecast tomorrow where a spring or a bunch of rabbits are going to be, but you're going to use your memory as to where that spring and those rabbits are. But the same tools mislead us when it comes to investing because the future, in fact, is so discontinuous from the past. And I think that we don't want to just throw up our hands, however, and say, oh, gee, the future is totally unpredictable, so there's nothing that we can do. We want to rather harness that unpredictability because there are things that are predictable. And one of those is the behavioral errors of people who think they can predict the future. And one of my favorite stories or studies is by my colleague Sam Hansen, who studied Greek ship owners. And one of the things that he found is that when shipping prices are very high, Greek ship owners plug all of these inputs into their DCF models, and they say, wow, current shipping rates, the shipping market is vastly profitable. I can go build a new ship and earn like a 30, 40, 50% IRR on building this ship. So let's go out and order a bunch of new ships at the South Korean shipyards. And then 2 or 3 years later, because that's how long it takes to build a ship, they get the ships delivered, and they, excitedly call their captains and say, "Hey, gee, how are our new ships doing?" They say, "Oh, it's not very good." So not very good. What happened? And they said, "Well, shipping rates have cratered." And so, why have shipping rates cratered? And they said, well, it turns out there's a glut of new deliveries on the market. It's a glut of new deliveries on the market. How did that happen? And what they don't realize, right, is that in a competitive market, the inputs to the model that they were using were the same inputs everybody else was using. And this is the phenomenon Sam Hansen calls competition neglect, which is a wonderful term. And I think there's a lot of competition neglect in markets. We don't realize that the same things that are driving us to make decisions are driving everyone else to make decisions, that investing has to be meta-analytic about what it is that we know relative to what everyone else knows. And I think my argument in The Humble Investor is that the one thing that we know that perhaps everybody else doesn't is that the world is much more unpredictable than people think. So what we want to do is bet against hubris, bet against consensus, find the things where the vast majority of people agree and where that agreement is priced in, and bet against correlated beliefs.
One of the interesting angles that you spoke about that I'd never really thought about before is just how sometimes both the confidence in our forecasting ability, as well as the fact that, we have some of these models that we all agree upon, can directly contribute to volatility in markets. Do you mind explaining that for the audience a little bit?
Yeah. So Robert Shiller won the Nobel Prize for his work on excess volatility. And what excess volatility is basically, if you think at any given point a stock is worth the future cash flows discounted back to the present. The only problem with that is that we don't know what future cash flows are, and we don't know what future discount rates are. But if we look back into the past, we do know, right? So we can know what the true value of the market was in 1931 or 1935, or the value of any individual stock on the market for that matter. And so what Shiller does is he looks and calculates what the true fundamental value of the market was over long periods of time, and then compares that to the market prices. And he finds out that changes in the fundamental value, the true value, with including future information, which obviously they didn't have, explains only 5 to 20% of market volatility. The other 80 to 95% is not explainable by the fundamental data that should be, in theory, driving market pricing. And so the challenge to us is to say, well, what drives that excess volatility? Because it's a challenge in some ways to efficient market hypothesis, right? Or to extreme forms of that, which say, oh, the price is always right. Well, the price can't always be right because clearly prices are too volatile relative to fundamentals. So the price isn't always right. Now, the sort of weaker form of that efficient markets hypothesis, which is that markets are really hard to beat, it doesn't challenge that, obviously. But the interpretation that I think best explains excess volatility comes from a sort of obscure professor at Stanford, Mordecai Kurtz, who has a theory of rational beliefs. And his theory of rational beliefs is that at any given time, there are a variety of potential futures. And based on historical information, it's totally rational to believe in any of those potential futures. Because we don't know the future. So you can't disprove any one of them, right? If you're in December 2019, you said, I think 2020 is going to be defined by some massive, contagious disease that's going to spread from China and force the country to go crazy. So what are you talking about? There's no reason to think that isn't even a possibility, but that would have been the right one. So sort of surprising things happen all the time. And again, we can't disprove anyone else's view of the future. And I think if you think to political disagreements or business disagreements, so many of them are better interpreted through this rational beliefs lens, right? You say Trump's tariffs are bad. I say Trump's tariffs are good. What we're really doing is making a forecast of how the tariffs will impact the economy. But because neither of us know, because we don't know what the future is, actually both our views are rational. Neither of us is wrong or right. We can't know. 6 months from now, we could know, but then what's going to happen as the future basically forecloses, as the future happens, it forecloses these alternative histories. And these many people who had bet on these alternative histories coming to pass. And so then all those people, having made a forecast error, have to go and revisit their forecasts. And that's what creates market volatility. And I think that's the right interpretation. And so, it's funny, but you don't see the term forecast error in any economics textbooks, but any of us who have ever invested in markets know that this is a defining attribute of life in markets. We're always making forecast errors. Otherwise, you're not betting and not a participant. And so the question is, logically, right, those forecasts are a component of markets. And of course, they're a driver of market volatility.
It is such a nuanced perspective and such a well-stated one. And I think it probably applies even to investors, whether they're doing it themselves or they have an advisor, just the viewpoint of the world, understanding, I think people seek to understand. They make mistakes during periods of volatility, something I do want to ask you about, but I want to pull on the string that you just gave to me a little bit more. You manage a large hedge fund, and I think this viewpoint of the world must impact how you make investment decisions. Do you mind digging in a little deeper there and explaining how that might impact the way that, or at least the lens through which you are both making an investment decision to start as well as evaluating an investment decision after the fact, whether that's 5 months from now or 5 years from now?
Yeah. So I think there's an element of which this view is freeing in some ways. And one of my mentors has a great line that he taught his kids, which I love, which is, when you know what your principles are, it's not the decisions that are hard, it's the consequences of your decisions. And I think there's a truth to that, right? I think of quantitative investing or systematic investing, which is what we do in that context. So how do we make investment decisions, right? I think what I think is that, if you look at Phil Tetlock's work, and Phil Tetlock is probably the world's leading expert on forecasting. And of course, one of his big findings is that nobody can predict anything with any degree of accuracy. And experts in the field are actually are really problematic because experts tend to be no more accurate, but much more confident. And so they're sort of the worst of the breed, right? Like don't go to the Yale foreign policy school to figure out what's going to happen in Russia next year, right? Like you're just going to get some overconfident person who's going to tell you something with great degree of certainty that sounds really right, but it just isn't at all. So instead, what he advocates is this tool or method of thinking called historical probabilities or base rates. And the way to think about historical probabilities or base rates is think about you're doing a renovation on your kitchen, okay? And you ask the contractor, how long is it going to take to renovate this kitchen? And they say, 4 months. Uh, right? That's their forecast. You're getting an expert forecast. Now you then say, well, have you done kitchen renovations like this before? And they said, yes, we've done about 10 of them. And you say, well, what's the average time it took you to complete those 10? And they say, well, 17 months. And then you say, well, wow, I'm seeing a big difference between the historical base rates and your own forecast, right? And which is more reliable? Well, of course, the historical base rate is more reliable. Now, that's an example for kitchen renovation, but what about for investments, right? One way you might think about, we can think about it in a cross section or in a time series. So in a cross section, we're thinking about ranking stocks. And so we might say, what I really want to buy is high quality stocks. I'm going to come up with my favorite metric of quality. And then I'm going to rank stocks by quality. And what I want to know is, how, if I choose stocks based on quality, how well am I going to do? And what's the spectrum of outcomes? And what that is going to lead you to a conclusion is it's going to be like, hey, over the long term, this quality stock thing outperforms by 1 or 2 percentage points, but with a 5% standard deviation such that over any given year, I really don't know, but over any 3 to 5 year period, maybe I can expect to earn something consistent. And I think you just start to frame your conclusions much more probabilistically. But you're going to spend a lot less time thinking, I've spent 6 months understanding one company to make a really complicated discounted cash flow model on it, because you're going to know intuitively that's an impossible task. And so I think a lot of it is sort of saying, let's stop doing the things that aren't going to work. Discounted cash flow models are a great example. They're just not helpful. They're not going to work. They're going to mislead you. They're going to make you overconfident. And let's start doing things that do work, like, how has X predicted Y in the past with what historical probabilities? And if I'm betting on X, therefore I can now understand the probability that Y will happen.
I have to mention, so I started my career as a stock analyst. And when you do a discounted cash flow model, for those who are not familiar, you're putting everything about a company's financials onto a spreadsheet. And when the first time you see one and you're taught how to build one, you do feel like you have precision and knowledge of the company's inner workings. But the thing that really blew my mind, like really never made sense to me, and I think ultimately informed a lot of my philosophy on investing, is most of the model came down to what you predicted the cost of capital to be. If you assigned one growth, yes, you do have to predict a sales growth rate. You do have to predict where margins go. But man, this one variable that you can't possibly know was where the big predictor was. Now, kind of using that to transition, you've actually highlighted valuation, though, as a pretty effective tool for predicting equity returns. Why do you feel that low valuation stocks in particular consistently outperform, and how can investors practically implement this insight?
Well, first, I'll quibble with the word consistently. I hate adverbs generally, but I'll
that's fair, because it depends on the time frame. Yes, my clients might challenge that
but not
too.
consistently.
Yeah.
So, yes, but I'll talk about that more. So valuation, is such an interesting thing, right? And I think the way I think about valuation, right, is you think about what is a discounted cash flow model. It is you're valuing a company, and the biggest input to that company's valuations are its future growth rate and the discount rate, the cost of capital assumption that you're putting in there, right? And the cost of capital assumption measures how risky you think it is, and the growth rate is how much you're going to grow. And you look at those two numbers, and you're going to come to a conclusion about what the company is worth. And then you can take that value and compare it to current book value or current cash flow or current profit or sales or whatever, right? You have a ratio of the sort of market valuation to some thing in the financials. And ultimately, what you're going to see is that that valuation is a measure of optimism or pessimism, of confidence in the company or skepticism of it. The richer the valuation relative to the current financials, the more excited other people are. And the more pessimistic, the worse the future valuation is, right? And you can think of sort of a simple, like, let's imagine the apocalypse is happening 2 years from now. And we have two companies, that made paid $50 each last year. One of those companies is valued at $100 because it's going to earn $50 for each of the next 2 years, right? So that person is just saying, hey, the same thing will happen the next 2 years that happened last year. And the other is valued at $1,000. So somehow they think it's going to earn, massively more. I think if you then think intuitively, like, well, if my view is that the future is really unpredictable and we have no clue what the next 2 years are going to happen, well, I'm obviously better choosing the one that's valued at 100 than the one that's valued at 1,000, because we don't know. Now there's some,
and the only thing we know is price. Price you do know.
Price you do
it's
know.
The only certain thing you got.
Right, and of course there are a lot of nuances. Okay, so let's start with some nuances. Right, would be some companies might be intrinsically worth more regardless of their future growth. Okay, so simplistically, let's think of two businesses that do exactly the same thing. One that owns all their own real estate and one that leases their own real estate. The one that owns their own real estate is just more valuable, right? Because they own the real estate. Okay, so you're going to value the real estate and the company, right? So it's not like valuation is purely about growth rate and discount rates. There are a lot of other factors, or one is a really high return on assets and one is a really low return on assets, or one is located in Romania and the other is located in California. One is listed on the Budapest Stock Exchange, one is listed on the NASDAQ, right? They're all things that are going to shape your valuation. So it's not all about growth and discount rates, but that's the majority. And so what you're trying to do is isolate that. Like, let's isolate the growth component of this from the stuff that's sort of intrinsically true about the company. And that will be a very clean metric of consensus optimism or pessimism. And then our intuition should be that we should avoid the things that consensus is too extremely optimistic about, and prefer the ones that the consensus is extremely pessimistic about. And what you see then unfold, sort of in reality, if you sort of play forward value a year, what you see is that on average, the things that the market's really optimistic about have better fundamental results over the next year than the stocks that people are pessimistic about. However, you fast forward to a year, now you're not forecasting, you're making a forecast inclusive of that. You're making a forecast about future years. And it turns out that the extreme optimism just fades, right? Or maybe some good things happen that year, and so fewer good things happen in the future. And the pessimism also fades. And so the multiples mean revert, and that creates the value effect. Another way to think about this, sort of I think it's quite elegant, is that we did a study of Japanese companies, because Japanese companies are required to issue guidance, and so we divided the world into companies that had low, medium, and high growth guidance, and they're forecasting 1 year forward. So companies' own CEO forecasting 1 year forward. And the TSE requires them, if the forecasts are the results are going to be outside a certain range of the forecast, they have to issue some update to the stock exchange, right? So there's a lot of incentives for accuracy here, and everyone has to do it. So there's no sort of lemons problem like there is in the US. And what you find is that if companies are at 50% accurate at sorting into the categories, right? So if they think they're going to be high growth, 50% of the time they're going to be high growth, which is better than 30%, right? Or 1/3. So there is some ability to predict the future 1 year forward for companies. The management has some sense of what's going to happen. But then when you start to interact this with market pricing and returns is where it gets interesting, because it turns out that if you look at the companies that say they're going to grow really fast, that do grow really fast, they beat the market. And it turns out that companies that say they're not going to grow fast and don't grow fast, they underperform by a little bit, right? So, you're sort of like, okay, gee, the world is sort of roughly right. But the problem is the other 50% of the time when the companies forecast high growth and don't achieve it. Well, what happens? Well, the stock underperforms by a lot because you set them up for high expectations you didn't achieve. You told your wife you're going to be home at 5:30 and you're home at 8. She's not happy. On the other hand, you said you were going to do that business travel next week, and then it's canceled, and you're home and can help with the kids. And that's the value stock, right? Where they said they were going to have slow growth, and they had a high growth. And of course, the outcome is quite positive from the market perspective, such that, interestingly enough, knowing what the management's growth forecast is has no predictive power over the stock whatsoever, because it's priced in, and enough of the time it doesn't work. that you don't make any money off the signal. So it's just one of those sort of ways of thinking, or trying to change your perspective around value and growth and forecasts to understanding this sort of metacognition about what's baked into the market price and how to analyze your own view relative to that.
Well, and I think that people who have subscribed to value investing, which I'll say in kind of a nebulous, broad way, because we could probably nail it down a little bit deeper, particularly in the U.S., have really had their religion tested because U.S. large growth has just dominated anything that is an investable asset class that you could put in one of those asset class return quilts. Large cap growth is at the top. So people have doubts. And let me ask you, Dan, what do you feel like are some of the bigger misconceptions about value investing and the validity of it, and why you still believe in the concept of it being persistent and working going forward? Again, and I'm saying working going forward in a pretty nebulous, broad way. And you can go as specific as you want, but just recognizing that.
So I'd say let's bifurcate the world into U.S. and international. Value investing has worked just fine internationally. So if you look at the performance of small cap value indices versus large cap indices, they've done better internationally than large cap indices. So the value premium still works, okay? It just doesn't work in the U.S. or hasn't worked in the U.S. So what makes the U.S. special is really the question. What makes the U.S. special over the last 10, 15 years? And I think there's a simple and obvious answer to that question, which is I talked about value being based on historical probabilities, right? And betting on sort of consensus optimism being wrong. But something has happened in the U.S. over the last 15 years. And what is that? A major technological revolution where consensus optimism about technological innovation was underestimating the actual impact of that innovation. We are living through an age akin to the Renaissance, the development of the railroad or the steam engine. This is something that will be in the history books for hundreds of years about what just happened in the United States over the last 20 years. Think of the technologies that have been developed, right? The cloud, mobile, AI, right? These are revolutionary tools, and they've changed the way society is, right? Think about the impacts of phones on schools or phones on kids. Think about the impact that AI is going to have on a whole variety of professions. Think of the impact the internet has had on our day-to-day life. These are massive, revolutionary technological changes, and the companies that created those technological changes have made huge amounts of money, and the people that bet on those technological changes have made huge amounts of money. So yes, this has been a period where buying boring industrial companies at single-digit PE multiples has not worked as well as investing in high-growth, exciting technology and software stuff. Now, how long will that technological revolution continue? How rare are those has there ever been a time for music as wonderful as Vienna in the 17th and 18th century? No, right? Will there ever be a time again in our lifetimes where we see such massive technological change? Probably not. And so I think that my view is that, yes, we've lived through a special time, but should we forecast that special time is always going to be special, or that it's even special in other places, right? Like Japan didn't have a great AI revolution, nor did Europe. There are no great tech companies there. So these technological revolutions are often concentrated in very narrow periods of time among very narrow sets of people in very narrow places that sort of foster that innovation. That Silicon Valley is to tech what Vienna was to classical music, or Florence was to Renaissance literature and painting. And that's an exciting thing to live through, but it's not a very good thing for being a skeptical, pessimistic value investor who thinks that things are going to mean revert, because they just didn't. But again, you travel outside of that special case to Europe or Japan, and value investing's done just fine. And I think that thinking about the future, it's more likely that we're going to live in a more normal time than that these special technological revolutions will continue. That said, the special technological revolution could continue, and Gen AI could become AGI, and then all of a sudden all bets are off, which is certainly what our largest tech companies are betting on.
It's interesting, and I don't want to get too off track. The largest tech companies, I mentioned being a stock analyst when I was younger, and there was something about the diversified industrial, a company that was fascinated to me, where they kept deviating from their core business to move the needle. And I do see that happening a little bit with the tech companies. However, they have so much money. The only way to move the needle is to take big bets and try to innovate and move forward. And yes, you're right. Those bets have paid off. I appreciate the perspective of really people underestimated the impact of the revolution that we were going through. At the same time, as you mentioned, in the international space outside the U.S., not as much exciting stuff going on. If it's 2007 through 2010, most of the clients and investors I worked with were always saying, why do we have so much U.S. exposure? Why don't we have more international, especially China, especially the BRICS, the BRIC countries? Fast forward to today, and the U.S. has trounced them. 2025 international's made its comeback. Maybe it's permanent, maybe it's not. But U.S. investors have been skeptical about international diversification recently. I guess, why is this skepticism potentially misplaced? And how should investors strategically think about geographic diversification today?
Yeah, I think that one sort of useful barometer, and I talk about consensus optimism and consensus pessimism, is for those of us in the investment world, just listen to what you're hearing. And if you hear the same thing from 2 or 3 or 4 people that work in the industry, be pretty careful about whatever that thing is. And I think let me talk about some of those sort of consensus things. And by the way, they're changing. So you rewind to last year, there were a few things that were sort of consensus. One of which is the U.S. is the only place worth investing. Diversification is diversification, right? And everybody who had said that or believed that had basically been right. And there was a tremendous pressure on people to reduce their international allocations, tremendous pressure. And I saw many people fall prey to it and saying, gee, do we need international stocks? A lot of our companies sell internationally. Let's take international to 0% or 10% or 20%. And if you look at 2025, what a terrible mistake that was, right? It happened so quickly, but so much of the historical rationale for that was that U.S. stocks just done so much better, but a big portion of that was currencies, and another big portion was valuation multiples, and currencies have unwound, and there's been some economic stimulus in Europe now, and both multiples are rebounding there. So these things are so temporary. And diversification is a bet against hubris. Don't put all your eggs in one basket because you really don't know the future, and something could happen to that basket whether you like it or not. So be diversified. It's just logical. But there are other consensus things about private equity. Holy smokes! I've been talking about this for years. And by the way, I feel like I was some sort of like sideshow clown, that dropped me out at a conference to give the anti-private equity view. And then people would say, ha, 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 he's so clever, but totally wrong. It was amusing for people to hear, but they didn't care as they took their private equity allocation from 10 to 20 to 30 to 40. 40, 45, 50, 60. I mean, you would be shocked at the stories I've heard of people, the percentages that people put in private equity. Shockingly high. But the logic was there, well, beats the market. Beats the market. So why wouldn't we? And I like the market. So isn't this just the market on steroids? And I can take, long-term risk because I'm so, have so much money or whatever. So, the last few years, private equity has underperformed the market and they can't sell any of this stuff, and distributions are at all-time lows, and it's just a disaster. And people are really reevaluating that. Now, of course, private credit remains the apple of investors' eye because they get the interest payments. There's no DPI problem. But I think that these in fads, they go in and out of fashion, and really what you want to do is stay out of the fads, and that requires diversification, that requires a long-term perspective, and it requires periods where you are going to feel dumb or you're going to feel like you're not a very good investor because you're underperforming whatever the thing is that's hot, and that's fine. And you have to, be okay with that, right? Because again, when you know your principles, it's not the decisions that are hard, it's the consequences. There will be hard consequences for taking the right path. The right answer is never easy to execute on, but it's still right, and it does pay off.
I'm going to ask you about both private equity and private credit in just a second, but to round out kind of the international angle, you've been particularly cautious, or your language is pretty cautious around emerging markets, particularly highlighting China. Why should investors be cautious when investing in these countries in general?
One of the preconditions to a successful market or successful economy is secure property rights. And unfortunately, many emerging and developing markets do not have secure property rights. China happens to be a communist country. And communists are not hot on property rights, even as they've tried to make reforms to make themselves more, communism or socialism with Chinese characteristics, one of which seems like sort of some shadow version of property rights, but they're still not really property rights. And so my view is that, first of all, that you're better off in countries where your property rights are in fact secure, because ultimately your claim to ownership and your claim to those future cash flows is dependent upon the law enforcing that claim. So there are non-market considerations, right? We need order and law to protect our property claims, and that without that, your property claim is worthless. And the other thing is geopolitical tension, which is, I think, the erection of capital barriers and trade constraints. And I think that, those are problematic. And as a U.S. investor, I like to invest in countries where we have a U.S. military presence on the ground. Makes me feel safer. I'm going to get my money back. Versus countries that seem like they have potentially hostile militaries, which seem like places I might be less likely to get my money back as a U.S. investor.
It's kind of, you'd mentioned on the international side that a lot of people felt pressure to decrease their international exposure coming into this year and maybe in prior years at just the exactly wrong time. And coming out of the Knots decade, I think a lot of people felt pressure to invest more in emerging markets. Just to give people an inside look for what my role entails when you're setting capital market assumptions, when you're doing asset allocation. At the time, if we were to go to like 2010 or 2011, there was barely 20 years worth of emerging market data. It's hard to make statistical inferences from that amount of return data, which, by the way, if you put it in an optimizer, it would have told you to put 40% of your portfolio into emerging markets. You can make some inferences on volatility, and for whatever it's worth, and there's all sorts of disclosures at the end of the podcast, so I don't think I'm doing anything wrong here, but we've been underweight emerging markets for my entire tenure at Plain Corp that spans a decade. And a lot of it's because, we don't know if we have a statistically strong enough sample to infer returns, but we do have a statistically strong enough sample to infer volatility. And I think adding on the property rights is something that is really something important to think about. And I don't think you or I would ever rule out that, hey, China could outperform in the next decade, and so could emerging markets. That's why you diversify. You own a little bit of everything, but you do have to stay out of the fads and recognize what a fad is. And so let's get into what I feel like are the biggest fads. You already referenced them in passing. I'm going to ask you first about private equity, and then we'll move on to private credit. But the endowment model is what made this popular. You have quite a bit of evidence that shows that the returns may not justify the hype. Can you walk us through some of that?
Yeah. So I think a few years ago, I was arguing against the historical returns. So saying, hey, the historical returns are very good, but the future returns won't look as good. Now I can make an even easier argument, which is that the historical returns aren't very good. The past 1, 3, 5 years, private equity has underperformed the stock market. So why should you lock up your capital for 10 to 12 years and pay 4, 5, 6% per year fees for the privilege of locking up your capital to underperform a public equity index? You shouldn't. Is the correct answer. You should avoid this stuff nearly at all costs at the moment. Maybe it's a little better now than it was 2 or 3 years ago because the fundraising has declined, and so the excessive capitals is kind of starting to ease from kind of peak 100 out of 100 to 95 out of 100, but it's still pretty crazy out there. And so, why is private equity such a bad idea at this point in the U.S.? I'll say, and private equity isn't bad and completely. It's just bad at certain times, at certain places, at certain valuations. And the problem right now is that massive amounts of money poured into this asset class, and as a result, it drove up valuations to very high levels. And the level of irresponsible activity to very high levels. And fundamentally, what the asset class is buying companies that are really too small to be publicly listed. And so you're dumping money into the universe of companies that are really mostly too small to be publicly listed, and you're doing so with a lot of financial debt. And the results of those are creating something that's very small. Small companies with a lot of debt are very risky and illiquid. But you pump money into a group of those things in aggregate, and you can see big changes in the valuations because illiquid things are sensitive to capital flows, and that's what happened. So the returns got sort of pumped as the asset class grew, because if the asset class was 2x bigger than it was 5 years ago, you could exit your 5 years ago investment to somebody else who just raised a 2x bigger fund and needed to put capital to work, even if it wasn't the best thing in the world. You could still sell it. Well, now fundraising is shrinking, capitals or flows are flowing out of this illiquid asset class, and the exact same thing is happening in reverse, where it turns out you can't sell it, and turns out it's too small and has too much debt for the public market investors to want it. And sort of the irony of thinking about the public market, all these allocators shifted so much money out of public markets, and so like you're saying, we're going to sell it to the active small cap public equity investors. You're like, the active small cap public equity investors. Anyone met one of those? I mean, are any of them still in business? I mean, I don't know any. Like, I'm looking around. I was actually at a small cap active manager conference a few months ago, and it was great. One of the guys said, we were talking about private equity, and one of the guys said, did you know that in the worst year for private equity, results or fundraising, 700 private equity funds closed? And the other guy goes, oh gosh, so many people out of work, that's so sad. And the other guy said, no, in private equity, when a fund closes, it means that they raise the money. The other, but it was like, of course, in the mutual fund world, right, closing is shutting down. So you've just had this world in which, and by the way, like, you can talk to pretty much any multifamily office or RIA in the country, but even external to the country, world over, because I talk to all of them, and such a large percentage will say, quote unquote, we follow the endowment model. We think that all of our alpha is going to come from privates, and so we allocate 30-40% of the portfolio to privates, blah, 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 right? Like this thing, it's like a meme, a mimetic idea that has taken over the world. And of course it's taken over the world when the people promoting the idea are earning 2 and 20 fees on 12-year locked up capital. This is like the most lucrative thing known to man. And of course they become very good at convincing everybody that they should do it. But it's a bad idea. It's a bad idea right now. It's a bad idea in the U.S., and it's massively overlevered. They can't exit these things. The asset class is now shrinking. The smartest people are getting out or reducing their exposure, which is striking. I will say that. I've seen that in the past 6 months. It's a big turn. The smartest people have changed their mind already, and they are getting out or reducing their allocations.
Yeah, and one of the things that I don't believe that most investors or advisors who are putting their clients into this space understand that even if you have, say, a 15% return, that might sound good, but for the amount of risk that you took to get that 15% return, you probably should have been cheering for like 25%. And what most people using the endowment model language misunderstand, and let me tell you, Dan, we manage like a lot of endowments and institutions, some as small as like $10 million and some as big as, say, like $400 million. And because of their size, they think we need to follow the endowment model. And it's like, well, hold on. A Yale, for example, has different terms than everybody else. They have liquidity that, like, if they want their money out of a manager, that manager wants them in their next vintage because that's how they're going to promote the fund. And so they're going to get all sorts of advantages that even the largest wirehouses and family offices in the world are not going to get. And so, yes, I like that you have the data in the book to point out that the returns haven't been as good. Even if you could identify the best managers, they won't necessarily take your money. And I just think, people underestimate the risk that they took to get the returns that they ultimately achieved. There's probably, private credit today, and I'll let you kind of go off on private credit on whichever way you want to go. I sort of know what your views are, but private credit to me there's something similar happening in the sense that people love yield, one. And it's higher yield, but it's being pitched as safer despite higher yield. And again, I'm more worried about the advisors pitching it than I am investors clamoring for it. What are the things that you see in the private credit space that give you pause and concern?
Yeah. So I think the first thing is that yield does not return. Yield does not return. Markets are efficient. Credit markets are efficient. What does it mean that credit markets are efficient? What credit markets being efficient means is that higher yielding things have higher bankruptcy rates, and that the yield is compensating you for the risk of bankruptcy, period. End of story. That is it. That's the argument. Now, the strange thing about bankruptcy is that bankruptcy comes in cycles. There will be no bankruptcies for a period of time, and then there'll be a lot of bankruptcies. And so predicting which companies are going to go bankrupt is something that has to be done with good statistical data. And it turns out we're really good at predicting this stuff. Okay, like Moody's, you can get mad at the credit ratings agents all you want, but their models are very good and very well calibrated. And when they tell you that something is a triple C rated thing, that thing really is much more likely to go bankrupt. And those things in aggregate will experience much higher bankruptcy rates than things that are rated triple B, et cetera, on and down the road. And so when you hear, I should buy this higher yielding thing, you are not, in fact, going to necessarily earn a higher return buying the higher yielding thing than buying a lower yielding thing, because markets are efficient. And yet people don't understand the very simple insight into the way the world of lending works. Right? Lending to your buddy at 25% because he can't pay his credit card bills could be a really good 25% returning investment, or he could just never pay you back, which is what's going to happen with people that lend at extraordinarily high yields. This is why payday lenders have not all compounded at 35% a year for the past 50 years and are governing the entire world, whereas people that lend very conservatively have actually done pretty darn well. So what private credit is lending at very high yields to very risky private equity-backed companies that are A, too small, and B, too levered, and will in aggregate go bankrupt at much higher rates in the next financial crisis or the next big wave of bankruptcies. But what these private credit firms have done, and there's a great story in Bloomberg about this, have found these credit ratings agencies, these second-tier ratings agencies. One of them's run out of a townhouse in the main line in Philadelphia with like 6 employees, and they rate like 45,000 private credit instruments a year or something. And they rank, unsurprisingly, they're all rated triple B, just like the mortgage stuff. And this stuff isn't triple B, right? I mean, it's 10, 11, 12% yield. Sorry, it's not triple B. It's triple C. And you are all going to discover that at the worst possible time. And it's just such a story, like rapid expansions of credit never end well. And so it's the same story we've seen over and over and over again. Savings and loan crisis, the expansion of mortgage to subprime, right? We just see the story over and over again. And it's so easy of a lesson to learn. And yet we never seem to be able to learn it because the irresistibility of buying higher yielding things in our portfolios is too great.
Well put, Dan. We have gone longer than I promised you we'd go. I feel like I could have dug deeper on a number of different topics. I'm obviously going to link to the book in the show notes at thelongterminvestor.com. But if people want to follow along with you and read your regular insights, where can they find you?
So I'm on X at @FordadCap. And then you can also, through my link there in my bio, sign up for my weekly email where we share our latest research.
Yeah, and you have lots of archived research that people can download, and I think people really enjoy. So everyone go ahead and check out Dan. And Dan, thanks again for joining us here today.
My pleasure, Peter. Thank you.